Cisco just had the kind of day that changes the entire conversation. Their shares are rallying hard on one simple fact. Enterprise customers are flooding them with AI infrastructure orders. And I mean flooding. This isn't hype. This is real money moving through real pipelines. Welcome back to TechMeHome MarketPhase Daily News. This matters because it validates everything the bull case has been screaming for the last year. Companies aren't just talking about AI anymore. They're spending. Cisco's the middleman in that conversation. They make the networking gear that powers data centers. When Cisco wins, semiconductors win. When semiconductors win, the entire equity market gets a permission slip to keep climbing. But here's where it gets interesting. The dollar is having an even bigger day than Cisco, and that's the real story nobody's talking about yet. The DXY is strengthening on rising probability of Fed rate hikes. Think of it like this. Imagine you're at a casino and the house just announced it's raising the payout odds on every bet. Suddenly, money floods back into the casino because the returns are better. That's what happens when interest rates go up. The dollar becomes more attractive. Money comes home. Now here's the tension. Trump is literally in Beijing right now meeting with Xi Jinping, and every minute that meeting is happening, markets are pricing in tail risk. Tail risk is the stuff that doesn't fit the base case. A trade war, new tariffs, supply chain chaos. That's the shadow hanging over today's rally. The Dow futures are climbing, but they're climbing with a question mark attached. Meanwhile, Fidelity just sent a shockwave through the ETF universe. They're charging service fees on 100 more ETFs. This is the death knell for the zero-fee era, and it's going to crush boutique fund managers hardest. Retail investors need to audit their holdings today. You might wake up in 3 months and realize your ETF costs just doubled. Nobody told you. It was buried in an SEC filing. But here's the beautiful irony. Gold miners are having the best year in forever. Gold is rallying because of exactly what scares markets: inflation hedging demand and geopolitical uncertainty. The Trump-Xi summit, the Fed rate hike odds, the fact that governments keep printing money, it's all pushing smart money into precious metals. Gold mining stocks are reporting record results and enhancing shareholder returns. That sector is working. And then you've got KKR-backed GMR Solutions raising $479 million in an IPO for ambulance services. Yeah, ambulances. Healthcare infrastructure is the new frontier. Private equity is consolidating it. And the market is rewarding the thesis. That tells you something about where institutional capital thinks growth is happening. Here's what this all means for your portfolio right now. We're in a moment where three forces are colliding. 1. Corporate earnings are real and strong. 2. The Fed is signaling higher rates. 3. Geopolitical risk is tangible. If you're 100% in growth stocks, you're vulnerable to rate hikes crushing valuations. If you're 100% in cash, you're getting crushed by inflation and missing the earnings rally. The smart move is a split position. Own some growth. Own some hedges. Own some dollar-denominated assets. Be diversified. The bottom line is this. Thursday, May 14th, 2026 is the day Cisco proved AI spending is real. The dollar reminded the world who's still the reserve currency, and Trump and Xi's meeting created just enough uncertainty to keep volatility on the menu. Markets are up, but they're up with caution. That's actually healthy. None of this is financial advice. This is purely for entertainment. Always do your own research before making any investment decision. Subscribe for daily market breakdowns. Stay sharp.